This is part one of our project and is over idiosyncratic volatility in the CAPM. This slide basically shows and quantifies how much each stock is taken on in total risk. The first column is total risk. This basically just describes the variance of returns for each stock. Systematic risk explains the variance by exposure to the market via the beta. Idiosyncratic volatility is the standard deviation of the residuals, which is just an unexplained noise in the market. The percentage of idiosyncratic volatility is the portion of risk not explained by the market, which is a key concern for the CIO. The CIO explicitly prohibits investments of any stock over 70%, which you can see all of our stocks exceed that threshold. KO and J&G both have the two highest. KO is pushing 87%, while J&G is pushing 86%. Even Microsoft, which is considered a blue chip giant tech company, still has a 72.76% idiosyncratic volatility percentage. This implies that none of these stocks are eligible under the current portfolio, considering the constraints that we were given. Last project, we recommended NVIDIA to you guys because of the low beta, which means that it has less fluctuation in the market. When the market goes up, it goes up less. When it goes down less, which is good for risk-averse people. But after doing this project, based on its idiosyncratic volatility, it appears to be a risky investment, as 82% of its total risk stems from company-specific factors rather than the broad market movements. This high level of unsystematic risk makes NVIDIA less predictable and potentially more risky due to the internal events, such as earnings surprises or product developments. While this may be acceptable for investors with diversified portfolios who are seeking high growth opportunities, it poses as a concern for the risk-averse investors or those looking for a more stable stock. Therefore, based solely on the idiosyncratic volatility, this stock may not be the best option to invest in. For part two, the first part, we were assigned to find the average monthly return, the standard deviation, and the Sharpe ratio of these five investing factors, and we used the Fama French 5 factor model to do that. We found the mean, standard deviation, and Sharpe ratio. The mean is basically the average monthly return of the factors over the 10 years. Standard deviation represents the risk or the volatility that you are taking on. And the Sharpe ratio just measures how good the return compared to the risk is for the stock. Looking at the results, the market risk premium had a decent return and a positive Sharpe ratio, more importantly, meaning it gave good return for its risk. SMB had a negative Sharpe ratio, which means it's not a good factor to rely on in this case. HML also had a negative Sharpe ratio, again, not a good stock to invest in. RMW had the highest positive return and the highest Sharpe ratio, which means you are getting a better return for the risk you're taking on. And the CMA finally has a negative return on the Sharpe ratio, which means it is not a helpful stock for your portfolio. Basically, this just shows you what factors add value to you over time, and it allows you to identify the best return per unit of risk you take on. So for this slide, part two is the variance covariance matrix. This basically shows how similar or different the movements of the five factors are in terms of actual risk levels. In simpler terms, the high numbers mean two factors tend to move together in the same direction with similar strengths, while the lower and negative numbers mean they either don't move together or go in opposite directions. For example, HML and CMA have a higher number together, so they move together a lot, while RMW and the market move a little in opposite directions. This may not always be the worst thing, while it can help reduce risk when combined. Just why this basically matters is knowing how factors move together can help build low-risk factor portfolios by mixing the right ones together. This slide is the correlation matrix. It is a lot like the last slide, just easier to read. This slide, the numbers are measured on a scale from -1 to 1. 1 means the two stocks move perfectly together. 0 would mean no correlation, while -1 means they move exactly opposite. Some key takeaways from this are HML and CMA have a very strong connection, as you can see, while RMW and SMB move in opposite directions, which can show profitability, while the HML and CMA can show value in the investment. This tells us which factors give you diversification, just like the last slide. For example, RMW and SMB might reduce risk because they don't move together.
In question 2, part 4, we were asked by Ross to see if we could use the 5 factors and use them and combine them into a single factor by using equal weights in each of them. So in order to do that, we use this line here, which is just all of the factors divided by 5. So you're having a 20% weight in each of them. That gives you this amount here. And we did another regression analysis versus the returns. And you can see that in here on the right side. These over here are our single factor alphas. What you notice is that they goes up by quite a bit on most of them. The alpha increases, meaning that more of the return cannot be explained by our model. And you also see that in the lower R-squared values, just meaning that the goodness of fit of the data doesn't really match with the returns of the stock. You see much lower R values in the single variable compared to the single factor. And then you also see it in the p-values. You're seeing much higher p-values, meaning that there's less statistical significance. Overall, this just shows that the single factor equal weight is not very good at, or not as strong at predicting the movement of the stock returns, and that by making it more simple, you lose out on a lot of the statistical significance, and your model is just not as strong at predicting the movement of the stock. In test 5, you were tasked by your boss to use a single factor to find the alphas, but instead of using equal weights in all of the 5 factors, you thought of the idea to use the minimum variance portfolio or the maximum Sharpe portfolio. So to do that, we calculated the variance covariance matrix of the 5 factors, and we can use that to calculate the variance and the of the portfolio and the returns. So the returns is just your average return of the portfolio times its weight, and then you sum those up, and then the variance is calculated using using a cross multiplication of the whole table. So in order to get the Sharpe ratio, we use solver to maximize this Sharpe ratio here. So we set a variable to max, and then by changing the 4 weights up here, and since this one is not one of the ones we're changing, H5, we set it greater than 0 because we don't want a negative weight in R. And when we solve that, you get this number here, which I've summarized over here. You basically get a 0 weight for the CMA, but and then 401 and 0.59 in the RMW. And then for the minimum variance, you do something similar. Solver, you want to set the V17 to a minimum. And you get something along these lines, which I've summarized over here. And using that data, the average return of these is 0.15 and 0.57 respectively, and the standard deviations and the Sharpe ratios. Once you have that, you can use these weights and multiply them by the factors over here. And this is, so we use the weight, which I moved over here. So these weights were the ones we calculated. And for this minimum variance, you multiply the market risk premium by its weight, and you sum them all up, and you get this single factor here. And similar to the last one, you run a regression analysis of the stock returns versus these stocks here, or this single factor here. And when you do that, and you do it as well for the Sharpe ratio, you get the alphas in respect to the minimum variance portfolio, weighted portfolio, and the max Sharpe weighted portfolio. And what you notice is that with the max Sharpe weighted portfolio, you get a similar outcome to the 5 factor data. And with the minimum variance, you would just, since this portfolio is not on the asset allocation line, you just do not you get much higher alphas because your portfolio is not a very strong portfolio, so your data is just not going to be very good at predicting outcomes compared to the max Sharpe ratio. But this here summarizes all of our alphas from our 5 different strategies. And what you notice is that using all these complex formulas, you don't really get a much better picture than just using a standard CAPM formula. And overall, the NVIDIA, no matter which one you use, NVIDIA is clearly the one that outperforms the most. So our recommendation to the university would be to choose NVIDIA due to the fact that it clearly has the highest alpha, no matter how you measure it and which factors you input into it. In test 3, we were asked to price a bond, a 30-year 8% coupon government-issued bond, using the rates given to us by the GSW and LW method. The GSW method just uses the current price of known bonds and interpolates the price of the other bonds using just a straight line interpolation. Meanwhile, the LW approach uses other factor data like the economic and inflation data to price the bonds. You can see that this causes well, first off, the correlation is quite similar. So they do tend to price bonds similarly, but there's slight differences that you can see on this graph here. The LW version leads to a lower in the 10 to 15 year and the 27, and then higher in the 20 to 25 year range. This could just be due to economic outlook and inflation outlook. And you also see that the LW graph is a little bit more choppy and not as straight line as the GSW graph. Using the term structure of those interest rates to price a 30-year 8% annual coupon bond, we can just price each cash flow and discount it at the spot rate given by each different different version of interpolating price discount rates. So using the $8 on a $100 par, so the cash flows would be $8 for 29 years, and then your $108 in the final year. You would just discount the $8 by the $8 over the rate to the maturity this 1 year. So you see up here in the top, it's this rate divided by 100, give you a percent or decimal version to the power of the maturity year, and that gives you the present value of that future cash flow is $7.6. And if you do that for all the cash flows, you get that the price to be $168.19. And similarly for the LW method, you do the exact same thing, and to price those future cash flows, the present value is $169. So the LW method has a lower yield to maturity since it's a higher cost, and this could just be because, as seen in the graph here, you have lower rates for here and here, and there's a little bit higher rate area, but the graph, you have more rates that are lower, and also here at the end, the rates are lower, and the farther out into the future, the more impact it has because you're putting it to the power of 30 instead of these earlier years. So these lower rates at the end is probably what's really causing this lower yield to maturity. And then in the next task, we were asked to find the price of a 6% coupon bond that pays semi-annually. It has 7 years to maturity using just one of the term structures. And so in order to do that, I picked the GSW term structure. And just since it uses the straight line interpolation, and so given that you know the 1 year, 2 year, 3 year from the GSW over here, you can plug that into, I used a website to calculate the, interpolate the values. So you plug in your points at 1, your rates at 1, 2, and 3, and this provides you the spline interpolation. And then if you wanted to get the rate for 1.5 years, you would have, this is the spot rate at 1.5 years. The only issue with this is that since you don't have a year 0, in order to calculate that, I just used the spot rate at year 1 and year 1.5, the difference of that, and added it on here, just so it's a continuous growth. And then once you do that, you need to transfer this over into semi-annual periods. So you just multiply the year by 2 and the rate divided by 2. And then similarly, you discount. So since it's a 6% annual bond, the semi-annual cash flow would be $3 on a $100 par. So you would just discount that $3 cash flow by the semi-annual rate to the semi-annual period. So similar to the last one, your cash flow divided by the rate in a decimal to the period. And then when you sum all those cash flows, you get $112, which is a yield to maturity of 3.9% annually. This seems to track as most of these later yields are around that 3.9% mark, and the later yields are more impactful on the cash flows, especially this last yield, since that's where most of the cash flow is occurring. So that's why that yield to maturity is lower, even though the average of these yields is probably higher than this yield to maturity.